Hello, my name is Larry Word. I am a CPA with a master's degree in business administration from Mercer University right here in Atlanta, Georgia. One of the things that you want to do on your personal taxes is itemize your deduction. If you have the standard deduction, the government is really handing it to you. They're going to get as much money as they can from you. When you itemize your deductions using a Schedule A, then you can lower your tax liability. What we want to do is lower your tax liability, not cheat or not falsify anything. We want to lower your tax liability. Now, the main thing that the government is still allowing is mortgage interest on your house. You can deduct the mortgage interest on your house, and you can do it up to two houses, one house and your vacation house. So you can deduct the mortgage interest, you can deduct the real estate taxes on that house, and sometimes you can deduct the premium insurance if it's on your 1096. Your 1096 is the form that they give you at the end of the year to deduct your mortgage interest and your real estate taxes. One of the good things that's still going on, you can deduct charitable donations to your church or Salvation Army or to any nonprofit that you are associated with. You can deduct either cash, clothes, vehicles, or boats. So that's a good thing that's still allowed in the tax code. You can deduct taxes, state taxes, that they deduct from your W-2. So that's why itemization of your taxes is very important. You can deduct casualty and theft or someone break into your house and steal some valuable items. You can deduct the amount above the amount your insurance pays you. So if there's a $10,000 deductible and you have to pay it, you can deduct that $10,000 because you lost it. Another thing you can deduct if you are working for a company and you do a lot of traveling for the company as a salesman or someone of that nature, you can deduct travel expenses, you can deduct per diem expenses, you can deduct supplies that you buy, food when you're eating out, cell phone, meals, up to 50%. A lot of people loan people money, and a lot of people don't like to pay back, especially in this economic times that we're going through now. Did you know that you can deduct personal loans that you loan to people and they don't pay it back? You can deduct up to $3,000 per year on a personal loan that you loan to an individual and they don't pay it back. You have to have some documentation and just get the person to sign a piece of paper that they are not going to pay you back. That's fine with you because you're going to deduct it on your taxes. And it can go for as long as the person owes you taxes. If they owe you $21,000, you can do it for 7 years. $3,000 per year for 7 years until it's cleared up. Now, earned income credit is still good. If you're not making a lot of money, you can deduct up to 3 dependents on your earned income credit. A lot of people are really using this, especially during this time when people are losing jobs. That is the basic amounts that you can deduct as itemized deductions on your personal tax return. Now, itemized deductions are different from tax credits. Now, the final thing I'm going to talk about in this segment is the business expenses you can deduct. Once you start your business, one of those 3 businesses, sole proprietor, partnership, or corporation or LLC, once you start that, you can deduct these expenses from your income. Now, one thing about having a business, you can have a loss in 1 year and you can carry it forward 20 years and backwards 3 years. So you can basically have a real good year and a real bad year and not pay any taxes at all. And that's one of the big benefits you have when you have your own business. I talked about executive bonus plan. This is a retirement plan that you set up yourself for your retirement, and you get to manage the money. Some people use this money to buy antique cars.
It's gonna be 150 rare. Gonna be 100 and a half. 100 and a half. Gonna be $100,000. Gonna be 100. 100. Hello, Hugh. How you doing? Gonna be 100,000. Gonna be 100. 75 grand. We're gonna be 75.
Now, another thing you can write off. A lot of you pay your children, give your children allowances. Why not put them in your business? And the money that you give to them, you can write it off as salary. Wow. Never thought of that, did you? You can write that off and pay the salaries of the kids. You can pay your kids up to $600 without even giving them a 1099. You can even put the cars that you own in your business name and write the lease payments off. Instead of paying them personally, you're paying them in their business name. You have employee education expenses. You can write those off. And remember, your kids, they are employees. So if you're beyond the threshold for writing off educational expenses, you can do it this way. Pay your child's tuition because they are an employee. You can also write off interest on business loans. You can write off interest on mortgages, taxes on your real estate, and of course payroll taxes. You get to write those off. Income taxes that you pay on the business, insurance, employee benefits, R&D costs, business bad debts. You can write off meals and entertainment expenses, professional fees that you pay to accountants and lawyers, travel to the board of directors meeting. You can have a board of directors meeting just like Exxon, Mobil, or some of those big companies. You can have an executive business meeting in Hawaii or in Dubai, and you can write the whole thing off because it's a business expense.